Hey everyone, welcome to FinanceFeeds Podcast. This is a new format. We're going video and audio this time. On our first video episode, I'm joined by James Alexander, who's Chief Commercial Officer at 26 Degrees Global Markets. James, it's a pleasure to see you once again on another side of the globe.
It's a pleasure to be here. Thank you so much for having me. Really awesome to get together again.
Yeah, absolutely. So I want to jump right in, and to kick off our discussion, I think we need to address the orange, let's say, in the room, which is Donald J. Trump.
Yep.
Obviously, he's been in the news a lot and will be for the next 3 to 4 years. I wanted to ask you, did his recent announcements about tariffs and other things kind of catch everyone in your niche of the industry sort of off guard? Did your clients need help to better hedge their positions and manage risk during that time? Because it seemed like it was quite volatile. And, how are you helping clients adjust sort of their risk profiles as we move forward in this, I would say, kind of unpredictable world in terms of fundamentals?
Yeah, for sure. It's been a really interesting time, obviously. It's funny because the US election was probably the most over-prepared event in the broking market generally. I mean, I think everyone was well prepared for the actual US election process itself, which turned out to be a bit of a non-event really from a volatility point of view.
Sure.
We had a couple of little jolts in the Asia session, but apart from that, it was a relatively quiet all day. But little were we to know that was just the start of the act. And the main game was really still yet to come, which is those tariffs. So I think it is fair to say that the tariffs in their scope and in their breadth really did catch a lot of people by surprise. And I think that certainly in terms of the market reaction, you can tell that was not well priced in. The way that markets reacted in those early days and weeks to those tariff announcements shows that much of the market was caught off guard. And that's investors, fund managers, asset managers, and of course, the broking community. Now, to say that was caught off guard doesn't mean to say that people were ill prepared for volatility, just that they weren't expecting something of that magnitude so early into the president's new tenure. So I think it's safe to say that there was surprising amounts of volatility at that time, and that impacted a number of different markets. I think, the markets that were most heavily impacted from those Trump tariffs, I guess through the lens of the broking community, more so than perhaps asset managers, has really been that precious metals market. That was particularly heavily impacted. As with the equity markets, indices and these sorts of things really did take a talking to. And with the precious metals market, what was funny is that it actually kind of played out in a way that was similar, but different to what we saw over COVID. Similar in the sense that the tariffs presented this concern that the import of physical bullion into the United States, for delivery into the CME for hedging purposes, was going to be subject to these tariffs. So all of a sudden you've got this additional cost, unknown at the time, in its sort of quantity, that can potentially increase hedging costs for a lot of market makers in the precious metals market. And that was sort of almost a repeat of what we saw over COVID, where delivery into the United States of bullion was challenged, not because of tariffs, but because of logistical issues, cargo issues. People couldn't get London Loco gold into the CME. So it was kind of a bit of a story of same, but different in some ways. But look, regardless, the volatility is there, and it doesn't look like it's going to diminish anytime soon. And the conversations that have really sort of, I guess, been front of mind for us in terms of those client-facing conversations, how do clients face into and address this new environment that we find ourselves in, where you've got a high concentration of trading volume is taking place in precious metals and a small number of instruments? The diversification of trade volumes isn't anywhere near like it was 2 years ago or 3 years ago. We work and operate right now in a highly concentrated environment. And that creates opportunities and it creates challenges. But one of the challenges that it creates is that you've got this highly correlated, highly concentrated flows coming in. And, that traditional internalization, externalization model that brokers run does sort of start to creak and groan a little if, they don't have a really well-defined workflow for hedging of internalized risk in scale. And that's the thing. Hedging of internalized risk is not a challenging thing, in small sort of parcels here and there. But when you start moving in scale in response to highly concentrated, rapidly accumulating risk on positions, and you've got to get out of big risk quickly. I think this is the workflow that's really been front of mind for us in a lot of these client conversations recently. So we've focused in terms of like what we're doing and what we're working on with clients most actively is control of hedging and optimizing some of the hedging activities in this highly concentrated environment. And also price control. You know, we have seen a lot of price volatility, particularly in precious metals and in indices. And that volatility is something that, you know, can be challenging for the retail brokers who are trying to deliver a stable, consistent product into their client demographics. So for us, it's really been about working on enhancing and, you know, further implementing volatility suppressing mechanisms within our pricing. But, and there's a big sort of but here, that doing so in a way that doesn't risk or doesn't undermine the strength of the price in terms of its mid-rate flexion. So is our price highly reflective of the market, or are volatility suppression mechanisms being achieved via other things like skewing of pricing? Which skewing of pricing is not in of itself a problem, but if done too extremely or done to too great an extent, it can create problems for the brokers who would consume those heavily skewed prices. So for us, it's been a focus on volatility suppression, but with a clear-minded focus that we wanted to be delivering a client product in that is highly valuable to them and doesn't expose our clients to unintended consequences. So that's those two areas, the execution optimization for hedging at scale and price stability have really been the two main drivers, you know, on our radar for the last 6 to 8 weeks.
I wanted to ask, have you made any changes in liquidity provision or order flow handling to support brokers, especially, like you said, you know, it's very highly concentrated, gold, other markets, I would say other commodity markets and indices and equities, right? Where we're seeing a lot of the action coming from the retail side, but also the institutional side. Has there been any changes there to kind of say, hey, listen, okay, this is a no-go now, or, you know, I don't know.
Look, there definitely has been one or two, and they're quite subtle, but I think important, because when you find yourself in this kind of environment where, again, you've got these highly concentrated flows in a small number of instruments being hedged in size, market impact becomes really crucial. So when brokers are looking to hedge these positions out, how well are their orders being handled and executed by their LPs? And we talk about, you know, there's a concept that we talk about internally, value at depth, which is kind of like ensuring that we're trying to deliver value, not just at the top of book price that we show to brokers, you know, which they often use to essentially price their retail customers, but value at depth, ensuring that when brokers are looking to hedge out in size, that we're providing value throughout the depth of that market that we're providing to brokers. And, you know, achieving that is one thing, and then achieving a really high quality execution off the back of that comes back to really carefully curated liquidity pools. Now, to speak practically, what does all that mean? What it means is, environments like this, you've got to be very careful about which LPs you're, you know, using for your hedging. And indeed, the same applies for us. It applies equally to us as it does to our customers. So we've actually been very proactively curating. By curating, I mean reducing in number the number of LPs that we'll have within certain hedging focused pools in an attempt to really mitigate any market impact that occurs. Now, these LPs we have the closest relationships with, they're generally LPs that have themselves, and I'm talking about, you know, the tier one investment. Some of the non-banks. And then the LPs that we've got great relationships with. And so for us, it's been a process of really actively working with our LPs in the same way we encourage our clients to work with us. So we don't just, you know, tell our clients, hey, it's great to have a good relationship with your LP. Like, it's as valuable to us and our business as it is for our clients. So, of course, you know, we do eat our own cooking in that regard. And that's been the real active process for us, just making sure that the market impact is managed, because, you know, with brokers sitting on substantial risk positions, if they are looking to hedge, if that's not done well, the value leakage that can occur for the broker themselves is significant. And I think in the last few months, we've probably seen significant value loss across, you know, our segment of the industry, given the volatility and sort of pricing challenges that we've seen. So I think that's, again, just been a more recent focus for us.
I think you're absolutely right. I mean, it's basically some people lost, some people won, right? If you think about it. Some people were prepared and they took action. Some people were unprepared, but they had the time, or in real time they took action, which kind of helped them mitigate risks, right? And some people just couldn't do anything and didn't really know what to do. At least that's what I've heard from, from industry players.
Yeah.
Who are like, hey.
And like, you've got to be very careful. I have to be very careful in particular that, a lot of our broker clients are very, very sophisticated. And I don't want my comments to be a reflection of the level of sophistication that many of them possess.
Yeah.
But it's more just a case of well-defined workflows. So, a lot of these retail brokers will have well-defined risk frameworks that cater well for the A and B and how they segment flows and internalize or don't. But I think when you see market dislocations like we saw with these tariff announcements, having workflows that are accommodative for those kind of situations is often something that businesses don't prepare well for. They don't drill the tail risk cases. And I think that's where potentially a couple of the desks were a little bit less prepared for how they should be well handling these types of concentrated trade flows they've seen.
Yep.
Because if you think back, the environment has really changed. Now, in the previous years, what we were all dealing with was a lack of volatility.
Right.
And that's quickly pivoted to the opposite. So, it is a bit of a change. And I think that's where the preparedness maybe was not as up to date as it could have been.
And that segues perfectly into my next question, because I want to take a step back and kind of look at sort of last year, because last year 26 Degrees where you guys were helping retail brokers make the transition from concentrated internalization model to a more active hedging and risk management approach. Yep. And this was obviously all a result of decreased or muted volatility that we saw over a couple of years, I guess maybe it was, or
definitely was,
maybe more, maybe less. How did that turn out before obviously we got into the Trump version 2 era?
It's a funny thing, volatility, because you're either dealing with too much or too little. That's the reality. There's very rarely in our business the sweet spot of volatility.
Sure.
The VIX is sort of hovering around 20, but maybe gets to 15 or 25. That's kind of our sweet spot. But the reality is often you're dealing with a VIX at 6 consistently and there's just nothing happening, or you've got the VIX at 50 and people are running around with their hair on fire. So it's kind of a bit of a feast or a famine. And, when we started thinking about the way we could work with our clients to optimize hedging, what we'd identified was there's internalization or externalization, A book, B book. And those things are done really quite well, to different levels. Brokers have got a good level of sophistication. They'll do whatever sort of metrics they want to perform for their analysis and their segmentation. And they're quite good at it. But we kind of identified this opportunity to say, well, look, when you've got that internalized risk, making sure it's hedged in a really efficient way is going to become increasingly important as the brokers grow.
Yeah.
And that has been seen, we're seeing brokers continuing to grow in size and balance sheet, and, there has been a consolidation as well.
Sure.
So we're seeing stronger entities, which is probably a good thing for the overall marketplace and the consumer. But this is an area that we sort of identified as where we wanted to focus. Now, at the time, volatility was really muted.
Yeah.
And gold was just grinding reliably higher. So it was just pushing higher day in, day out, not every day, but it was very consistent and volatility was minimal. So that creates a challenge. But the challenge we were facing into then was more a question of when to hedge. So we'd be talking to clients about, they've been sitting on risk for a while. They're a little uncomfortable with it. And we were talking and just consulting with them on, optimal times to be looking at their hedging.
Yeah.
Now, if you fast forward, those conversations were quite timely and, ultimately beneficial, but for a different reason than we were facing into at the time.
Yeah.
Because all of a sudden, the man in orange comes in, the script gets flipped, as they say, and we all find ourselves in a very different environment. Now, it's funny because the same sort of conversation still stands you in good stead, right? Coming back to that open relationship with a liquidity provider.
Yeah.
Now we're in a world where volatility is an extreme. So gold's still pushing higher. It does seem to be unrelenting at the moment. But it's also associated with significant volatility, which can be fantastic for brokers. We all like volatility, but again, the concentrated nature of the trade flows at the moment just makes that volatility a little bit harder to manage. And so this is where it's just an evolution of the same conversation we've been having for the last 2-3 years, which is that more sophisticated approach to hedging. So speaking practically, like, what does that mean? What does that actually kind of look like in these conversations with brokers? The areas that we focus on are kind of 3 things. There's, do the brokers require a dedicated hedging feed? Are they moving hedges in such size that they need a feed that's separate from their standard pricing execution?
Sure.
That are sort of attempts to offer up optimal pricing. Then we've got this concept of value at depth. Like, let's look at the size of the trades that you're executing, how frequently you're executing, and the efficiency of your executions. Are they good, or are you not achieving high quality executions, which is costing you significant money? So this concept of value at depth and making sure our entire order book is presented in a way that is dialed in for that particular broker's needs is sort of the second concept. And then there's the final part, which is when we, the liquidity provider, are handling the execution ourselves, how efficient are we at minimizing market impact? And that comes back to that curation of the pool of liquidity that we use before we overlay certain, factors and, quant pricing smarts as well on our side to really ensure that we're not just pricing well for that hedge price business. We're not just pricing in a way that correctly reflects the broker's desired order flow and sizes. We're actually then receiving those orders in the right size and actually handling them really well in the marketplace to get the best outcome. If you do those three things well, you're kind of in pretty good shape. That's not job done, but that's a big part of it. So I think for us, in terms of where we're focused on our side in these conversations, as volatility's kicked up, it's there.
I think if a layperson is going to be listening to our podcast, I would say, I like sports cars. And modern sports cars, they have comfort mode, sport mode. And so if we're talking about 2-3 years ago, we're in comfort mode, and now we're in sport mode, right? And the car has to be efficient both in comfort and in sport, right?
It's actually that simple. It really is. And as I said, it all comes back to good conversations. Again, when we talk about this shifting environment and risk desks who are handling these flows, these retail flows in the first instance, just having the optionality to change and pivot how they can operate and how they can hedge, it's so much easier if you've got a strong relationship with a good LP. It really is, because you can have a conversation like, guys, here's what I'm seeing on my side. Can we get something in place that's going to help me do what I need to do in the next, even if it's just for the next few months?
Sure.
I mean, that kind of value add is the difference between, a good operator and a great operator.
Is it? Yeah, absolutely. I wanted to also speak about pair CFDs, products that you've launched. It's been over a year now, right?
About a year and a half.
Yep. And it seems, almost prophetic, because you guys launched these products, obviously in what we just discussed, sort of a low volatility period. To me now, it's kind of like it's making correlated chaos tradable, right? I mean, you can basically create a tradable financial instrument out of many different things. And it seems like, especially like you said, it's a lot of concentrated volume in gold, equities, but what's going on in all the other asset classes, right? And so if you can mix and match things and kind of take advantage of it from that perspective, I guess I wanted to ask, with this Trump-driven sort of volatility, are you seeing even more increased demand for pair CFDs, or let's say some exotic pairs that perhaps didn't exist a few years ago, and now people are like, well, okay, we've got gold, but we've also got other instruments that maybe people are not really taking that much advantage of now. But if you can pair them together individually, but if you can pair them together, you've got a great product that top down you can essentially generate some revenue.
Yeah, look, it's been a really interesting one, actually, watching this evolve over the last few months as, the Trump situation has played out. Because with the Trump story, what we've seen is there's really clear thematic winners and losers. When Trump comes out and talks about tariffs, we're going to place these level of tariffs on these different countries. Conceptually, at the high level, without having to understand the nuance of things, people understand that. Traders understand if the US is going to start placing tariffs on, let's say, Japanese automakers, as an example.
Sure.
That's going to be bad for Japanese automakers. Japanese automakers, like you've got Toyota, you've got Subaru, you've got Nissan, you've got Honda. That's a big chunk of the Nikkei 225 index. These are things that are not super complex to grasp from a conceptual level. So when you put those two things together into a single trading instrument, like a pair CFD, where you've got, for example, the S&P 500 on one side versus the Nikkei 225, and you can buy or sell that combination, it makes these sorts of trading environments very actionable. Because while there's nothing complex in the construction of the instrument itself, and it's just like trading any other FX pair, euro versus the dollar or dollar versus the Japanese yen, it is that simple. It makes these thematic sort of concepts that you hear about on the news day in and day out, Trump's placing tariffs here and these sorts of things are playing out, it makes them very relatable and very tradable. So when people can grasp concepts or themes or narratives, it makes more complex ideas simple and easier to understand. And I think people feel a lot more confident, executing trades based on a theme or a narrative that they feel they well understand.
Yep.
So I think that a lot of the pairs instruments we've seen sort of most rapid increase in, particularly over the last 3 months, has been some of those equity index pairs, particularly involving the US indices, unsurprisingly.
Sure.
Against the China index, against the Japanese index. The other ones we've seen have kind of been a variation on the main prevailing theme, which is, this gold story. So we have seen gold against oil actually starting to become a really interesting trade, particularly at the moment with some of the geopolitical turmoil.
Right.
Obviously playing out now. And we're sort of seeing escalations of that as we speak.
Yeah.
So, the movement in gold in combination with the movement in oil is starting to create some really interesting trading opportunities there.
Mm-hmm.
And again, it's about finding things that people are comfortable with, that they can conceptually understand and relate to, and making them simple and executable.
Mm-hmm.
And I think that's where, the pairs product has a really strong place. It has been growing. It has been growing quite well. I think that, the full uptake and the full rollout amongst the retail broker world is still largely ahead of us.
Sure.
I think that like when we launched equity CFDs via API into brokers in 2017, uptake was initially sort of quite muted, to be very honest.
Mm-hmm.
But the reality is I don't know many of the major retail brokers these days that don't have some kind of equity CFD offering. Now, that comes with various degrees of trade flow, various degrees of interest. But I think as a product for diversification of revenues, it is quite important. And I think that increasingly it is these sorts of products, be they equity CFDs, be they pairs, be they just a broader access to asset classes, it is going to become an increasingly important differentiation point, not less.
Mm-hmm.
Because with all traditional metrics, top of book spreads in, the traditional instruments, competition can only take you so far.
Sure.
Brokers have to find new ways of diversifying revenues and attracting new customers. And I think these products actually do hold a significant key to that success.
Yeah. And I would also say, if looking at, let's say, internal trading volumes at large retail firms, traditionally, historically, it's always been, let's say, if you look top down, let's say you've got 100 or 300 instruments, you're always in your top 10 or your top 5 is always Eurodollar, gold, something else. And it seems like there's a lot of low-hanging fruit that have always been there.
Yep.
You know what I mean? They were just hanging on there by themselves.
Yeah.
And now if you pair them together, you've got something that's a lot more attractive in terms of volatility, in terms of pricing, and in terms of ultimately revenues, both for traders and brokers and LPs and everyone involved. So.
Yeah. And look, I think with this geopolitical climate we're in, without trying to, predict where geopolitics is going to take us over the next few years and the remainder of the 3.5 years of Trump's campaign, Trump's tenure, it would be surprising to me personally to see these sorts of, global, national level sort of conversations and dialogues diminishing. Like this seems like it's going to be with us for a while.
Oh, yes.
US sort of trying to exert its influence, other countries jockeying for position, trying to form coalitions, and this shifting power that we seem to be witnessing, sort of playing out right now. This is going to bode very well for these sorts of instruments, for equity markets, obviously for FX markets as well. I mean, we did see an extended period of volatility.
Of course,
FX markets are starting to show signs of enhanced volatility now compared to where they were, but really, the story's been, gold, it's been indices to a certain extent, and then crypto.
Yeah.
And that's been a big story of late as well.
Sure.
But, if we look forward, we do see these sort of thematics playing out. So, FX volumes sort of increasing in prominence again, but then also equities and some of these, pairs type instruments are absolutely coming to the fore a lot more than, you would witness in a lower volatility environment.
Yep. If we dig a little bit deeper into equities and let's say ETF CFDs, you've actually extended trading hours to include pre and post-market sessions. So essentially now you're covering 16 hours a day of trading. There's obviously companies in the US like 24X that are, I think they're going to, well, they've got approval, right, to launch an around the clock trading.
Yep.
What should we expect in the future? I mean, is this going to affect trading desks across the globe? I mean, you just mentioned in the beginning of our conversation, we've got lots of volatility. It's and we've got lots of order flow, but it's very concentrated.
Yeah.
Right. But now we're going to have something where markets that traditionally were quote unquote 9 to 5, right? Or there's a trading session, are essentially like euro dollar now. And again, euro dollar is still Friday close, Sunday open. And now essentially what we have is 365, right? 365 days a year. Anytime you want, boom, boom, boom. Is that going to put pressure on trading desks around the globe, on LPs, on even retail brokerages?
Look, I think it will. I think the pressure is going to be there. I think like anything, it's a challenge and an opportunity at the same time. The challenge will be staffing first and foremost for brokers themselves. I think the other big segment in the industry that's, really wrangling with this 24/7 challenge, in any asset class, be it equities, be it crypto markets, whatever it is the technology piece. Maintaining the level of uptime and the service delivery from the technology level is the thing that's going to increasingly require a very agile approach from either proprietary technologies, if they're built in-house, or technology vendors. So I think those two areas are going to be, an area of particular focus and a particular pressure over the next 2-3 years. The pressure for the trading desks, I think many of these trading desks are likely feeling this already with, the continuing emergence and expansion of the crypto markets. So I think a lot of desks have had to face into this resourcing issue to a certain extent. In my personal opinion, and I think, our opinion, 26 degrees, is that these markets are going to go 24 hours at some point.
Right.
It's just a question of when. It is inevitable. The world is going that way, and we should be preparing for all of the facets of service delivery and reliability, stability that, are expected of us. We should be well prepared for those things. So that's certainly how we're positioning, ourselves. When we pushed to 16 hours, US equities trading recently, the conversation was already not, should we prepare for 16? It's, we need to be prepared for shortfall. I think, coming specifically to US equities now, I think we'll be at 23, 5.5, a lot sooner than people think. But it will probably take longer than people think to get to 24/7. So, you mentioned 24X before. So they've just been approved for their license. They're launching in September, but they'll be launching with a 16-hour offering initially. But, without sort of revealing too much, it's very clear that their intention, as with other exchanges, they're keen to get to 24-hour trading as soon as possible. Now, there is the component of the DTCC in the US, which has to clear all these trades. They're going to be 23 hours by early next year. Or so they're saying. Now, I'm not going to speak for them or put words into their mouth, but that's what we've heard. Now, if that is the case, then I think what you'll find is that several exchanges will be targeting around that time for a 23-hour offering. The main exchanges who have already announced publicly that they're sort of interested in moving to extended hours, you've got CBOE, who is a preferred vendor of ours.
Of course.
You've got 24X, who, we've got relationships with as well. You've got NASDAQ as well, is looking to push, nicely NASDAQ, is looking to push into that space. So I think they're going to be there. And I think we'll be at 23-hour trading for US equities, 5.5 days a week, 2026 for sure. Like, in my mind, that's almost a done thing. It's just how long it then takes to get to 24/7. And I think, the trade clearing component of that on the US exchanges is going to be probably the determining timeline. Now, in the other sort of, I guess, if you step away from the exchanges, there are venues called ATSs, alternative trading systems in the US. There's a small number of them. One, I think there's 2 or 3 others that are coming online shortly, whose applications are going through the regulatory process. Now, they'll not be regulated exchanges. They will just be designated as alternative trading systems. Now, some of those are pricing 24 hours right now for US equities. Now, for us as a liquidity provider to, some very large retail names, one of the things we have to focus on is stability. Often our clients rely on us exclusively for delivery of prices, be they equities, indices, whatever it may be. So for us, we take a lot of comfort from relying on regulated exchanges as our ultimate price sources, and then we'll bring those together and curate those in a way that delivers a great product to our customers.
Mm-hmm.
And while I do think that ATSs have a space and they can supplement exchange liquidity, and I think they probably do a really good job of putting commercial pressure on exchanges to keep market makers honest and these sorts of things.
Yeah, sure.
The concept of relying on them in isolation is not something that we'd feel comfortable with from a reliability and a robustness point of view.
Mm-hmm. It makes sense.
So, when the exchanges are there, we'll be there day one. That's all I would commit to on our side, and it's something that we're well prepared for.
Mm-hmm. I'm also wondering AI, right? Machine learning.
Yep.
Again, for me as a layperson, it's kind of like, yeah, sure, you could probably slap some machine learning in there in terms of the trade execution and all of this stuff, because it's so, again, it will be, the trading hours are so extended. Like you said, okay, 16 through 23, but at some point we are 24/7 around the clock.
Yeah.
But at the same time, I'm like, well, I don't know, because you can't just rely on machine learning. You can't just rely on AI, I think, especially in a complex world, like you said. I mean, you've got, targeted expansion of volatility, not volatility, but trading volumes, right? Heavily concentrated. Yeah. That's obviously probably going to continue, I would think, right? And at the end of the day, you need a human to really sit there and monitor all of this and kind of take action if you need to. That's just my opinion.
Yeah. It's an interesting one. And look, we are, as a business, proactively looking at ways that we can integrate more AI. So there's a number of workflows that we've got which have AI, I won't say at their core, but are starting to rely more and more heavily on AI components and inputs and outputs. But ultimately, there is still a governance angle with AI. How much do you trust what goes in and what comes out of that AI system? And, I don't want to try and foresee where, this whole technology scenario is going to play out for the broking world.
Yeah.
But I do think that increasingly it is going to live as part of certain workflows, be they risk-based workflows, whether they be trading, pricing-based workflows. I think some of that is still very much evolving. Mm-hmm. I think, one thing is very, very clear, that in data analysis and analyzing data sort of post-trade or post-price data, AI is incredibly helpful. It brings a level of efficiency that would otherwise not be achievable.
Absolutely, yeah.
So I think in those areas, we have moved quickly to integrate AI very heavily as part of those workflows. Mm-hmm. In terms of the decision-making as to certain risk parameters or how we price, we're not there. We're not relying on AI for those things.
Yeah.
But it's more about having AI inform the humans and the smart people that work for our organization and, the quants and the traders to inform them as quickly as possible with information that can then
they need
inform the decisions. And really it's about that turnaround time that, AI has been incredible.
Is it?
Aside from that, I'm sure marketing leans on it a little bit too, but
of course,
I don't want to do them a disservice by saying that too much of their work comes out of AI, but I'm sure I'd say.
Yeah. But you're right. It seems like it can be a very, very valuable supplementary tool.
100%.
In all of these different things, and I think with post-trade analysis and things like that, that sort of segment of daily workflows is, I think, becoming even more and more important. Or for brokerages, for LPs, like for the whole market and exchanges, because again, there's just so much data, there's so many price feeds, there's so much flow every second of every day. Yeah. And obviously brokers always want to basically maximize their revenue, take advantage of low-hanging fruit. Yep. And if you don't take that step back and look at, okay, well, what did we have last week? What did we have a month ago? And things like that. And not just looking forward, but also looking back and saying, oh, well, look, again, if we go back to, Trump announced his tariffs, everything went haywire, right? And kind of like, all right, well, let's take a step back and see what we had going on. What was in the retail flow? What was in the institutional flow? Could we have taken a better advantage of this or of that at that particular hour, at that particular second, and these things?
Yeah, and I think it comes back to a comment, we made earlier whereby, it's not that risk desks aren't well sort of versed in handling risk in different types of trade flows. It's just how quickly they can react to those changes. because when you've been in a low volatility environment, you sort of fall into certain habits and certain customs become, the go-to for your day in and your day out.
Yeah.
But when things in the global markets change really quickly, adapting to that quickly and moving on those workflows in a way that's informed is actually kind of a challenge because, if you put yourself in the seat of a dealer on the desk, right, you can see what's playing out in front of you. You understand that things are changing and things are moving fast.
Yeah.
So, that's sort of almost a given. But to then have something to support your decision-making process as a dealer that you can point to unequivocally, look, here is what I'm seeing play out. And look, we're running these AI processes over the data, whether it be trade flow, pricing, whether it be netting percentages of flow, whether it be, the volatility that you're seeing within your own internalization book.
Yeah.
Giving dealers that information that allows them to say, here's why I want to change something. And empowering them again, like it comes back to that that comment of empowering. Because, intuition is a wonderful thing, and experience on the desk. Senior people that have been there, they've done that, they understand how these scenarios play out, and they know what they should be doing. But to empower them further with more timely data, it just makes their job easier, especially when they're having conversations internally with risk managers or owners of the business, for example.
Yeah.
And I think that's where those AI workflows can actually really assist in not just better decision making, but support better internal conversations.
Yeah, you're right. You're absolutely right. Well, James, that was a lot of topics, a lot of themes that we just covered. I know you've got a busy few days ahead, and then you're jetting off again.
It's usually the way it goes when you live in Australia, unfortunately. Right? Flying no matter where you are.
Yeah. Yep. But listen, I'm glad that we got a chance to sit down here in sunny Limassol, and it's always a pleasure to speak with you. I wish you the best of luck at the conference, in your travels, and I'm sure we'll see each other probably in the Middle East or Asia later on this year.
I'm guessing Middle East will be next.
Yep.
Thanks very much, Nikolai. I appreciate it.
Thanks so much. Always a pleasure. Cheers.